All right. Thank you, everybody, for attending on this Tuesday night. For Blue Tahoe Capital, we're going to do a deep dive and go into the numbers a lot more than we did in the previous webinar. This is a variance of what we normally do. This is a fund. We are looking at buying numerous properties, numerous small properties. So we've set it up a bit different. Also, we're buying mostly value-add properties. So because of that, we have also changed our payment structure, and it actually works out better for you. And I'll show you how here in the presentation. You know, for those of you who watched the last one, this is the same opening slide, but I put projected 20% plus IRR. That's because I never put in there what the return was projected to be for the partners. There was one slide that showed an average of 20 to 22%, I forget exactly what it is, per year average return. But I'm going to go deeper into that and show you how we came up with the numbers, what we're doing, how we're doing it, why we're doing it, and then have plenty of time for questions. So let's go ahead and get started. Again, projected 20% IRR is what we're looking at. First and foremost, our operating partner is Charles German. He is my brother, and he has been 7 years exclusively in Lake Tahoe investments. As a matter of fact, his whole portfolio is in Lake Tahoe. His whole portfolio. As a matter of fact, I'm going to pause for a second. Mo, give Charlie a call. He's on there, but he can't hear anything. I'm sorry to interrupt that, but let's go and do that. So my brother Charles, he's got his $20 million of investment all in Lake Tahoe. So he is 100% sold out to it, and he knows the reasons why, which we'll share with you in a moment. He currently has about 100 units there, along with some other properties that are there. And he's got a great presentation, if you haven't listened to it, how he turned over 20 years, took $20,000, did 20 deals, and turned it into a $20 million portfolio. So he's got a great success record, so I highly encourage you to watch that. Why Lake Tahoe? Increasing demand and decreasing supply. We'll go through the details over that, but the bottom line is they're building moratoriums. They make it extremely difficult to build anything. So there hasn't really been many apartments built in the last 20 years, 30 years. There's also decreasing supply of land, which is an interesting problem to have, and increasing demand. And then also all the restrictions they put add and make the cost of construction so much higher. So all of these things add up to a huge, huge opportunity because you've got decreasing supply, no new product coming on the market, but increased demand. And I'll tell you about that real quick. For those who listened to the first webinar, you'll know why we went through this, but I'm just going to do it real fast in an abbreviated version. First off, building moratoriums. Tahoe Regional Planning Agency, they basically encompass the whole Tahoe Basin, all the way from the top of the mountains all the way down. And they want to put a moratorium, they put a moratorium on development back in 1984. So you can't build anymore in there without extreme amount of regulation. It's the most stringent environmental controls in the country. And that's because they want to keep the lake pure. It's 99.991% pure, something along those lines. But they want to keep it there. And they do that by restricting development. Decreasing land supply. There's Conservancy. And it was created in '85. And again, to keep Lake Tahoe clean. And what they're doing is they are actually out buying land and putting deed restrictions that it can't be built on. So far, they've bought 4,700 parcels, over 6,500 acres, and they're continually buying more. And because of that, you've actually got a decreasing supply of land. That decreasing supply makes it harder. And combined with the building moratoriums and the ability to even build, is creating a huge opportunity. High cost. They also have additional regulations where you've got a residential unit of use. You can only, if you want to build a new house, you have to pretty much tear down a house or buy the right to residential unit of use from someone else who tore it down a property, and then you can only cover the same amount of land that was covered by that one property. So covers limitations. So our supply is extremely limited. Increasing demand. Everybody from California, especially during COVID, has been more busy than it ever has because people are getting out of the cities that are close. 3.5 hours to San Francisco, 2 hours to Sacramento, 1 hour to Reno and Sparks, 45 minutes to Carson City. So there's a lot of push going up there. Rent controls are always a question in California, because most of these properties will be in California, but they limit it to 5% plus the consumer price index. That means in 2020, the most you could raise was 7.7%. Now, if we could raise 7.7% every year, we would be heroes. So we actually limited it to 5%. And in the last year, Charlie's raised it up the max on the properties that he already has, and so have a lot of the other homeowners, apartment owners in that area. Now, if you rehab a property or a unit, let's say it goes vacant, you do a major rehab, then you can raise the rents to market as much as you want. And just like our properties in Hawaii that we bought, we're finding that the rents are about 30% low in those properties that need some work. Again, these are all smaller properties. There's only 1,776 total units of 6 units or more, and most of them are in that 6 to 20 unit range. Most of them built in the 60s and 70s because of that moratorium. Most of them mom and pop ownership because they're all small. Big players can't come in there and make sense with buying 6, 8, 10, 12, 20 unit properties. So part of our plan is to go through and aggregate, buy all these smaller properties, aggregate them into a large portfolio, and have a huge amount of the market there in Lake Tahoe. And not only that, the cost of construction is so high that we won't even have any competitions for quite a while. And in a housing study that I recently read there, they're 3,290 units short of what they need right now. And with no more building going on, that demand is only going to keep on going up. So we've created a fund, $1 million to $25 million, to purchase those undervalued and cash flowing properties, rehab as needed, raise the rents, refinance it, pull that money out, hold for cash flow. And then the big thing is create economies of scale to lower expenses and control the market, and then aggregate enough so that it would be good for to sell to a large player, because then a large player could come in there and buy a large swath of it. Here's a confusing part that a lot of people didn't really catch, and there have been a lot of questions on, because we're doing a preferred return this time. So of the cash flow, the first 7% return goes to the partners before there's any split. Then is split 70-30, with the partners getting 70%. So if you figure, if there's cash flow of 10%, let's just say, then the first 7% goes to the partners. The 3% left over is split 70-30, so the partners would get another 2.1. So they would end up with 9.1%, and the sponsors would only get 0.9%. So that is the reason for that, is we wanted to give preferred return to the partners, because when we're buying these properties, we're kicking out most of the residents and we're not having any cash flow the first year. But then we're creating a whole lot of value in year 2 and allowing us to refinance and pull that cash out. So cash flow, 7%. First thing we do is give it to partners. Next thing we do is split 70-30. Now, refi and sales proceeds. If there's any refis or sales, and we as sponsors decide to distribute that rather than reinvest it, which we have that option, because the whole idea is to refinance it, pull cash out, and go buy another property with it. So we're compounding those returns, which we can only do in a fund. So the first thing that gets done is 100% goes to the investors. Well, if we were short on cash flow for that 7% prep, that gets paid first. Then 100% of the refi proceeds goes to the partners. That's until they're paid 100% plus the 7% preferred plus the 70% of cash flow. Okay? Now, because we're giving all of that back, we're giving 100% of that back to the partners. After we get them paid 100% plus the 7% plus the 70% of cash flow, after the investors get that 100% and that other return, then it turns into a 50-50 split with the sponsor group and with the partners. Now, on our numbers, which I'll show you here in a few minutes, we're projecting a 20% IRR, actually over a 20% IRR to our partners. So even though all this looks a little bit confusing, cash flow, partners get the first 7%. And any refi and sales proceeds, 100% goes to the investors. Okay, so there's a huge benefit to the partners on that. So I'm sure we'll have more questions on that, but this is extremely generous, and I'm going to show you how it makes a lot more sense for you here in a minute. Again, we're buying properties at about $100,000 a door, putting $40,000, $50,000 a door into them, and turning around and having them worth $200,000 a door. So these are all value add. They're usually older owners, mismanaged, have deferred maintenance. And again, you can't get the big players to come in there because all the projects are too small, which gives us a huge leg up. The first property we're going to buy, these are in different order than we did last time, so it'll be a little bit different, is 1031 Moss. It's 12 units. We're paying $91,000 a unit, putting in $350,000 in rehab, so we're all in at about 140 grand a door. Okay, so after we have that done, everything is redone, redoing all the kitchens, all the bathrooms, all the flooring, sometimes replacing a bunch of sheetrock, doing anything that needs all the common areas. Now, our value after 5 years is expected at $221,000 per unit, so making almost 100 grand a unit on that, and 78% cash out refi. Now, again, if we have properties to buy, the sponsors, myself, my brother, and the other sponsorship team will make the decision when we refinance. If we're going to do a distribution, 100% goes back to the partners. If we don't do a distribution, then we take that cash and we're going to turn around and reinvest it into another property. That way your money can be compounding and we can use our existing fund to buy more properties, to have the economies of scale that we want to lower the expenses, and to provide us with a bigger portfolio so that we have a better exit strategy. Okay, so that's Moss. That's the first one we're buying. Next one is going to be Brockway. This one's another value add unit. $100,000 a unit, $550 in rehab. We'll be all in at $153. Again, 5-year value is about $226 a unit. This one we have a 97% cash out refi planned. Okay, that'll be the second one we're buying. And the third one is Larch. Now, Larch is only 6 units. They're a lot larger units. They're all 2- and 3-bedroom units, but the rehab has already been completed. So we're buying it for $224,000 a door, all in. But our 5-year value is looking at $327,000. Now, again, these are larger units, which is why the value is so much higher. Now, I did have in here 101% cash out refi. We're going to get to my spreadsheets here in a minute, but that was if we bought it with the existing debt and then refinanced it. Instead, I've changed those numbers. So we're going to go in there and buy that with agency debt right off the bat and have a lot lower out of pocket, which increases the yield for that particular property. So the first 3, 2 of them are value add and 1 is cash flow. So I'm using that model then to project out farther, okay? And again, you have that and that. Let me switch over to and show you a different, I want to go through the number. Okay, here is the normal, traditional investment presentation that I do that most people are accustomed to. Again, this is 1031 Moss. Here's our purchase information. Paying $1,001,000, $88,000 in closing costs, $350,000 in capital improvements, operating account $50,000. Now I put negative cash flow. We're funding that up front, $56,000, because it's going to be vacant for most of the year. So we'll have negative cash flow during that time frame. Our loan is relatively small, but it's an assumption at 4.75%. And so we're just going to leave that in place. And so it's a bridge loan, because just like all of the value add properties, we're going to have to get a bridge loan. So it's a very low to purchase price, loan to value, and a lot of capital, which is also why we have the large refinance. Now, here's something very important I want to show you. In a normal presentation, we would show the 5-year average investor ROI. If we just did this one property in our normal 85-15 split, then we're looking at a 10.7% average return on investor. I apologize. 10.7 5-year average investor return on investment. And that's because there's almost 100% cash out refi in year 2. So really, if you did that over 2 years, the return would be much higher. But that's why I put these two numbers in here, right here. First off, if we use the internal rate of return the way we normally do it on an 85-15 split, then the average ROI for the investor is not 10.7. If you use in IRR and the internal rate of return, IRR, that basically does a discounted cash flow based on when you get your money back. So money that you get back earlier is worth a lot more than money you get back later. So that takes that into account, which is why it's 10.7 in a normal transaction, how we would normally do. That's why the IRRs are so high. Okay. Now that's internal rate of return, and I'll show you where those numbers come from here in a moment. Now, got a $387,000 loan, 4.75% interest, 24-year loan term. So we could hold on to that forever, but that's a horrible loan. So we want to refinance it, and we're looking at a $1.5 million loan at 3.7% Fannie or Freddie, with 5 years of IO. So we're looking at doing that refinance in year 2. Show you an idea here. Current rent schedule. Here's our current unit mix, and our average rents are $894. Pretty dang low. Once we spend all that money fixing it up, our projected rents are $1,281. Now, Charlie, who manages a bunch of properties up there and has a bunch of properties, thinks that's low. So he thinks we'll be able to do better than that. But again, I'd rather under-promise and over-deliver. Okay? So that's our rents going up, $894 to $1,281. Just like all the other spreadsheets that I do. We've got our sponsor pro forma here in the middle. Now, we budgeted in their 8% collection loss. Really, in Tahoe, it's about 4%, about 2% vacancy, and about 2% collection loss over the last year. We also have, so we have net rental income, $169. Other income is $0. The way that the management companies work up there is they charge a management fee of about 8%, and then they also keep application fees, but they also get the expense of running those applications. They also get late fees because there's additional work in collecting late fees and things like that. And that's because the properties are too small to have any payroll. So we take that out of the equation, which is some lost other income, but we don't have the expense for it, and it's part of the management fees. Contract services, that's usually snow removal and landscaping. General and admin, that's all our normal operating cost. And maintenance and make ready, $7,800. Marketing, $2,000, which we probably won't even need. Utilities at $18,000. Insurance at $7,000. Property taxes at $12,000. Property taxes in California are fixed at 1.1% of the purchase price. So whatever you pay, it's public record. The taxing authority charges you 1.1%, and that's what it is, fixed pretty much forever. Okay. So we have net operating income of $104,000 in our budget, which is only slightly over their current. That's because we have more expenses in there. And our debt service giving us cash flow of $71,000. That's at an 8% vacancy rate. However, remember that I said year one we're going to have much higher. So this is pretty much a stabilized projection here. Now we go out 5 years. I budgeted 5% rental increase, rental bumps. We can go up to 7.7, and with the huge amount of demand, and last year was 7.7, we think 5% is pretty easily obtained. We have 2% built-in collection loss and a 6% vacancy and collection loss built in. So we've got pretty good cushion there, probably about $5,000 in cushion there. And we extrapolate out, raising rents 5%, raising all of our expenses by 2%, which actually I could go in here and change all these numbers and not have property tax go up because they're fixed, but I have those going up anyway. So there's a little bit of cushion in some of these numbers. But year one, I've got a 74% vacancy and collection loss plus the 6, so a total of 80%. That means we're going to lose $28,000 on our operating, and with our mortgage payment and everything else, $57,000 in negative cash flow, which is why I put that up here at the front. $56,000 is what I have up here. So we'll eat in about $1,000 into our operating account. Hopefully everybody is paying attention. Okay. So now we're looking at a value in year two of $2,220,000. Now, just to give you an idea, equals that divided by the number of units. I'm sorry, divided by 12. Let me just do that. So we're projecting that we will increase the value of the property to $185,000 per unit for year two to do a refinance, 70% cash out refi, agency debt, pay off the existing loan, have our costs, and have $1,135,000 in proceeds from that refinance. Okay, so that changes our debt service, which goes up, and then the value in year 5, 2.672. We'll sell it. We'll have cost of sale, pay off the existing loan, and have another proceeds of $1 million. So pretty good on all of that. We're raising on this particular property $1,257,000. $1,257,000, and we have almost all of that back in year two, and then another $1 million on top of that. So this is something that you're used to seeing. Again, everybody wants to know what's in it for them, and that's exactly what this is. This is what the property is planning on doing. Okay, so if we bought this property just like we normally do, this is what the property would do and provide 18.7% per year average return. And then at that 85-15 split, I think there might be an error in here, 10.7. And with a 7% pref, 11.3% per year average return. However, because so much of it comes back in year 2, you've got to look at the internal rate of return. Okay, so with that pref, the internal rate of return, because that $93,000 comes back and gets reinvested and creating more return, that pref turns into 26%. This $100,000 partner on our regular 10.7 would actually be a 22% IRR. It's a little more confusing, but it gives a better picture on value add properties, because it takes into consideration that, hey, I received my money back in year 2. Okay. However, remember, this is if we just did this one property with that particular split, that would be the return. But we're not. We're combining this with more properties. I also want to show you this right here. This is a highly overlooked section of our analysis. All this right here is from the very first page, how much we're paying for everything. We are all in at $137,000 per unit. And the value in year 5, $2,607,000 or $222,000. You can pretty much say, okay, there's 80 some odd thousand in profit. Well, we put a down payment of $104,000. So, we're doubling our equity on that, but we're actually getting it back in the refinance and then reinvesting it. Okay. So that is Moss. Okay. That's the first property we're going to buy. Now I'm going to do this again and go a little bit faster, because the second property we're going to buy is Brockway. Let me get to Brockway right here. Same scenario. We're going to be all in at $148,000 a door. With the pref, 23% preferred return. Again, low loan amount, $810,000, raising $1,423,000. So very low loan to value. Rents we're taking from $860 to $1,223. Income, this is the more important one here. Again, 80% collection loss, because we're planning on kicking most people out and redoing it. We're going to lose $63,000, which is in our budget, $63,000, so that we can pay that out of pocket. Okay. But then our value is going to be $2.8 million. Do the refi, we're going to pull out $1,113,000. Okay, in year 2. So again, if we were looking at this as one property, pulling out almost all of our cash in year 2 is huge, absolutely huge. But again, what's in it for me? That's what everybody always wants to know. What can I anticipate? Like I said, if we were doing one property in our regular 85-15 split, 10.3 per year average return, or a 19% IRR. Or with the pref scenario, a 23% IRR. Now this gives a good example. I'm going to go ahead and stop here for a minute. Year 1, there was nothing paid out. Okay, so that means the partners are owed $100,000. Investors owed $7,000. But when we refinance in year 2, we're going to take the cash flow that they get and also take enough out of the refinance proceeds to hit that 7% minimum return. And then we would give back 100% of the refi proceeds back to the partners. That would lower their capital account. So you put in $100,000 here in year 1, you're owed $7,000 for that first year. Again, it's preferred, not guaranteed. There are no guarantees. Preferred return 7%. Well, you didn't get it, so you're going to have to get it in year 2. When we do that, we give you $67,000 back. Your capital account goes from being $100,000 to $32,000. So if we give that money back, in year 2, that means we only have to pay 7% return on the $32,000. Okay, so that would be $2,257 of the cash flow. Okay, plus 70% of the remaining cash flow, so another $1,000. So they would get $3,319 on the amount of capital they got back. So because that's return of capital, now you've got $32,000 in return, and you're getting $3,300 back. That's a 10% return on your investment right there, rather than a 3.32. You follow that? It's a little bit confusing, but because the 7% is based on how much is still in your capital account. Well, if we give it to you back, it lowers that amount and lowers the amount of the pref. However, again, we're not going to give that back most likely. We're most likely going to reinvest it. And again, 23% preferred return, 23% projected return on that part of the property right there. Same scenario, we're all in at 2.2, 148,000, and it's worth $3,352,000, so $223 a door. So another great investment. Then we're going to go from there, and we are going to the third property we've got under contract to buy is called Larch. Oops, excuse me. Gotta find the right one. There we go. Okay. So here's Larch. This property has already been fully rehabbed. This one's completely done. It's the 3-bedroom and 2-bedroom property with a lot larger units. We're paying $200,000 a door. We've got our normal closing costs, our operating account, miscellaneous. And on this one, we are actually going to start off getting new agency debt at $840,000. Now, in the presentation that I did previously, this one was going to be another assumption and then refinance after a year. Every time I do these, I make a few tweaks to make it better or more conservative or more refined. And on this one, I did it this way. So $840,000 loan means we only have to raise $500,000. And so that's a lot less than what we would have. And the IRR with the prep on this one, 19.2. Now, if you look at the 25 and the 28, this one's actually lower with the pref because of when the money is received. Okay, I'll jump over there and I'll show you, because IRR takes into account how soon you get your money back. Okay, obviously it's a lot higher 5-year average return here because 85-15 split, but most of that is not until the end. We'll go through that here in a second. We did not raise the income, did not raise the rents. It's already done. So let's go over here. So we did not raise the income. We probably should have, and that would make it better. Let me see if it. That's not in there. Okay. So we're going to take the income from 120 to 151,000, the net income from 73 to 99, and that's going to take our value all the way up to almost $2 million, and our proceeds $1,106,000. Again, what's in it for me? Okay. So the property is going to do this. Property would be 33%. If we did the regular 85-15 split on the stabilized return, the return is better for the partners. Yes, it absolutely is. If we did it with a pref, it's a little bit less, well, quite a bit less, 19.4, and the IRR 19.2. So it's still almost a 20% IRR for the partners, which is still a spectacular return. But that's with two, this is one property that's cash flowing, and that's because you don't get your money back until the end. But a $100,000 investor will get cash flow 73, 7.3, 9%, 10%, 11%, and then back down to 8%. I'm not exactly sure why I did that. There's an error. I did not change the debt service because it's all I have. Okay, so after return of capital, 20%, 20.2%, or an IRR of 19.9. So that one is still spectacular. Let me show you this over here again. Paying $200,000 in, all in at 223, and our 5-year value $330,000. And again, that's because these are much larger units. Larger units, higher rents, more value. Now, what's our overall plan? So I'm going to show you this here. And this is very, very interesting, I think. Okay. So year one, this is $100,000 investors. Now, because I tweak these numbers all the time, these might be a little bit different than what we just went through, just because of constant tweaks. Because I constantly tweak them because I get more information and refine it. So somebody puts $100,000 investment into the first property. They don't get anything year one. Year two, $14,000, then $4,900, then $108. But that's because in year two, we took that money and reinvested it. Okay, the money that we took from reinvesting it went down here and got invested into property 4. Okay, so now we only have to, for a $100,000 investor, if it's the same investor, for example, if they want to put another $100,000 investment in here, really they're only putting in $22,760. Okay. Brockway is the same thing. We're doing a refinance in year 2, but we're going to be using the proceeds from that to reinvest into property 5. Larch, property 3, we're not. That is $96,000. That is $100,000 investment minus the first year's cash flow, because the cash flow is starting year 1. And then there's cash flow that goes on for that, and then you sell the property. Well, because we're taking those refinance dollars, turning them around and reinvesting them in the next 3 properties. So figure, now we have year 2, and then we're going out year 3. Now, year 3, if we bought a property just like Moss and did not reinvest that capital, then there's $91,000 in cash flow there. Now, again, we have the option to turn around and buy more properties with it, more properties. But the idea is to build up the portfolio. So overall IRR return that I want you to see right here, 27.93%. So it's an average return of 27, almost 28% per year average over 6 years, just with these 6 properties. And that is investing $100,000 in year 1, $100,000 on the first one, $100,000 on the second, $100,000 on the third. But then in year 2, the cash flow reinvests for you. So I did not do a calculation on how much you would get on that next property. But if you wanted to keep putting $100,000 per property, for example, then that's what that would look like. To follow? So this is just an example of year 1 buying the first 3 properties. We might buy 6 properties in the first year. We might buy 3. We might buy 10. We don't even know. We're just going to be raising money as we find the right opportunities. But I want to give an example of the first 3 properties, and if we bought the exact same ones in year 2, what that would look like in the overall return. So the reason we call this the growth fund is because you're hitting 28% internal rate of return on your investment, which is freaking huge. Okay? Absolutely huge. This growth fund is absolutely awesome and will make you a ton of money. And it's a little bit more complex. We have an operating partner that's there in Tahoe, my brother Charles, who's been operating there for the last 7 years exclusively. He's got all the contacts. We've got all the team in place. We've got everything ready to go. And we're buying the first one here in the next 3 days. Okay, 2 days, actually. So we're closing on Moss in 2 days. We're closing on the other 2 Brockway, probably next month, and Larch probably the month after that. And we're still looking for properties. There's still more that we can buy. So I want you to get on this train and make a whole lot of money in this growth fund. And so now we can take all this information and open it up to questions. So I'll need somebody to moderate those questions. Who can do that?
Can you hear me, Darwin?
There you are. There's Brian. Okay.
Yeah, first, no particular order here, but we've got a question that says, when does the fund actually end?
Well, we put on there that we can raise money for 2 years. And here's the whole thing. If we get going past that, we might open up a separate fund. So it's going to be, as far as open, it's going to be open for up to 2 years. And then we're looking at a 5-year hold, but that could be anywhere between 3 years and 7 years.
Okay. Looking at the risk request, put the on here. Well, some of these you've answered here. Can you walk me through the investor earning payout dollars from year to year? I think you covered that. Also, the post refinance distributions based on 100,000. So I think you've done that.
I'll just hit this again there, Brian, reading those. Okay, so for example, somebody invests $100,000 in Moss in year 1. No cash flow. Year 2, $14,000 in cash flow. But that will be diluted because we're buying another property at that $100,000. So really, your $100,000, you'll get 14 on that, and you'll get 5 in year 2 on Larch. Now, if you're you can't just invest in one. So the benefit is you invest in all of them if you can. If not, you just stay in the first one. And that first one, you still benefit from all of the future sales. And your percentage of ownership actually goes down, but it's of a larger piece of pie. And because let's just say that we have these 6 properties, and let's just say one of them doesn't do as well. You don't want to invest in the one that did bad, and you don't know up front which one's going to be great. And so what we're doing is we're spreading that out over all of the properties. So your ownership percentage goes down, but the percent of the total pie, of the total amount of pie goes up. So if you have $100,000 in $1 million fund, you own 10%. 10% worth $100,000. But if we raise another $1 million, you still have $100,000 in there. Well, now you only own 5%, but you own 5% of a $2 million portfolio, which is still $100,000. So it still remains constant on your value, but then you get to spread your risk out over all of the properties.
Thank you, Darwin. Another question. As long as the fund is reinvesting more and more properties, is there technically a cash distribution to the investor?
Yes, because after the first year, for example, on Moss right here, actually, I'm showing the wrong screen. Hold on a second. Let me go back to, okay, so on Moss, for example, yes, year 1, there's no cash flow, but year 2, there's cash flow there. Now, because that will be spread out percentage over all of the properties, you're still in, let's just say you just invest in Moss, okay? And you just invest in the first one. You put $100,000 in the first one. Well, yes, your percentage of ownership will go down as we buy more properties, so that amount will go down, but you are still accruing 7% return on your investment. Okay, so no matter what it is, you're always accruing 7%. So, that's better than any savings account or anything else you can get. So there still will be cash flow, and you still will be do that 7% plus 70% of additional cash flow.
Okay, Darwin, probably have to cover this again. It says, just to be clear, if I make a $100,000 investment, I'm not investing in one specific property, but investing in all of them.
That is correct.
Just some general questions about the eviction process. What do you know about the eviction process in that area?
It's the same. There's eviction moratoriums there also, but it's not a problem here. If you, with only having 1,776 units, if you don't pay your rent, you try and go somewhere else, you're not going to be able to pay anywhere. So the eviction moratorium is still in place, but they have not had problems at getting rid of people that aren't paying, and people still pay their rent because there's nowhere else for them to go. If they decide that they're not going to pay, they know they're going to be absolutely screwed on not be able to find housing somewhere else. One of the nice things about a small market.
Okay, what is the minimum amount to invest in this growth fund?
$50,000 is the minimum.
Okay. And does anyone know how a K1 looks like for a growth fund?
K1 looks identical to any other K1 because all it is your percentage of the income and expense and depreciation, et cetera. So that's going to be exactly the same. On the tax side, I was incorrect on something else. We will have, partners will have to file a California California return. And according to my CPA, it's an extra $150 to report it. And we probably will not have any taxes due until the sale of the portfolio anyway. So yes, there is a California return, and it's a click of a button because you get a K1 of your partnership earnings, and it's exactly the same as any other property. Rather than having one property, this one is numerous properties in the same fund. Think about it another way. If you're part owner in a 100-unit property, then you're getting a K1 based on those 100 units. The way that we're buying these, they're all bought by the fund. Each one is an individual LLC, 100% owned by the fund. So it doesn't really matter to you because you are invested in that fund, so you'll get a K1 based on whatever assets they own. So you'll still only get one K1 for that investment.
Okay, awesome. How does it work when someone joins in the middle of the fund?
In the middle of the fund, they don't earn the 7% up to that point, but they participate in every property just like everybody else.
Okay, who lives in these properties? Is it tourists? Is it permanent Tahoe residents?
No, these are people that live and work in the Lake Tahoe area. These are mainly blue collar. So they work for the resorts, they work for schools, they work for casinos, it's all renters by necessity is the nice way that people have put it, because the majority of the homes are too expensive for them to afford. There's a huge affordability problem there, and so they have to rent. There's no choice to buy, and if you want to try and go farther out, that's the only way to do it is go farther out.
Okay, question here says, you said there was nowhere else to go for renters, so they don't want to be evicted. Do you expect any difficulties in getting renters out when the lease is up?
No, one thing that we do on this when we first take over the property is we non-renew everybody, and actually in some cases have to pay to have people leave. But we get those all out and then redo all the units so that we can raise the rents, 30%, roughly.
Okay, several of the same question from several people. Is there an exit for investors?
The exit for the investors is when we sell the entire portfolio, and we see that as a sale to a larger entity. Now, you always have the right to sell any shares of stock you have in any LLC, and those are private sales. There's not a market for you to sell them. But if you said you wanted to get out, then you could offer that up to the other people that are in that fund, and generally somebody will want to buy your position.
Okay, will property taxes only increase at a sale, or will they also increase at a refi?
I am pretty sure, I'm 90% certain it's only on sale.
Okay, will we be notified every time you find a new property?
Absolutely. We're going to have monthly updates and tell everybody where we are, and every time we find a new property anyway, we're going to have another round of investments to come in to buy that property. So we will definitely be letting everybody know how everything's going every month, and also when we're looking at any new properties and when we refinance, we're going to let everybody know everything. I think that we're pretty transparent on everything and keeping everybody up to date. But we definitely have to do that more here because we're going to be buying more property and raising more money as we go along.
I believe the last one here, Darwin, just says, why not buy, rehab, and rent to tourists? Won't it generate more cash flow?
No, the tourists have higher turnover, and there's hundreds, if not thousands, of hotel and casino units for tourists. So no, as a matter of fact, somebody even asked, will there be a corporate unit they can stay at or something like that? And no, it just doesn't make sense. There's too many cheap hotels for tourists to go stay in. Don't say they're cheap, but they are. There's plenty of hotels to do that.
Okay, and then several asking about the timing. When can we call and when can we invest?
Well, we are closing our first property here day after tomorrow, and that's Moss. And so we've got most of that raised. There's a few more spots left to get into that first one and start earning your 7% pref. And then probably next month and the month after, we'll raise money for the next two, Brockway and Larch.
Well, you've answered all the questions, Darwin.
I'm sure there'll be more.
Yep.
Any other questions?
No, that's all we've got in at this point.
Okay, good. Well, I hope I answered all the questions. It's been a little bit more confusing for everybody involved because it's a little bit different. But again, I want to make sure to let me share this part of it. Hold on. Again, decreasing supply, increased huge barrier to entrance, increased demand, and again, the investors, I want to go over this one more time. Of the cash flow, first 7% per year goes to partners before there's any split. Then of the cash flow, that's just the operating cash flow, that then gets split 70-30, 70% to the partners on top of that. Then, if there is a refi or a sale, first thing we do is catch people up on their 7% preferred return. Then 100% goes to the investors until they're paid all of their proceeds, all of their original investment back. So they make 100% plus 7% plus 70% of cash flow. Then, because they have already received a great return and they have already received 100% of their cash back, they don't have anything invested. That's when it turns into a 50-50 split between the partners and the sponsors. And right now, I'm saying projected 20% plus internal rate of return when I just showed you the numbers based on doing just the first 3 properties and then doing another 3 in year 2 just like it, is almost a 28% return, overall internal rate of return. So this is a magnificent growth fund in a beautiful area, tax deduction to go look at your investments. So go up to Tahoe and enjoy your tax deduction. Tahoe is one of the most beautiful places on the planet. If you haven't been there, I highly recommend it. And with great properties. Again, the thing that really, really, really gets me is the fact that there's the conservancy, I'm sorry, I always mess up that word, conservancy, that is actively buying lots and retiring them so you cannot build on them. You have to buy a right to use, which if you were to build apartments would cost you about an extra $50,000 per unit to build. That's on top of the probably $500 to $800 per square foot in building costs to compete. So if you're going to build a market rate apartment in Lake Tahoe, it's going to cost you $350,000 per unit or so, and we're going to be all in at these at half that, less than half of that. So there's not really going to be any competition on market rate deals until our rents basically double. Our projected rents double. There will always be huge demand with more of the workforce, more of the people moving up there, getting out of especially San Francisco, San Jose, that area, and they can work remotely. They're buying houses. 75% of the houses bought in Lake Tahoe are second homes. They've got an all year round demand with the lake and the snow for visitors and casinos. Where are you going to go to? I mean, look at all the people that go from LA to Vegas. Same thing with San Francisco and that whole area going up to play at the casinos, either in Reno or Lake Tahoe. So huge demand, most beautiful place on earth, and a huge opportunity because of the decreasing supply and increasing demand. So, and the fact that rents are 30% low because there's no major competition that's a professional competitor. So I highly encourage everybody to go ahead and get some in there, even if it's $50,000. Just get it in there because this is going to be a great growth opportunity. Like I said, looking at close to 28% internal rate of return just on those first 6 properties. So contact David or Garrett here on this screen here, and they can get you hooked up. We've got a few positions left for our closing, which is happening in 2 days. And then after that, it'll be another month before anybody can get in. So again, thank you so much for participating. Is there any final questions there, Brian?
There are not.
All right, wonderful. We'll contact David and contact Garrett, and they can get you hooked up and involved in this right now. And like I said, I think this is going to be a spectacular growth fund. And with Charlie and his great success in that area and his investment success, being partners with us, looking out for you, it's a place to be. So reach out to him, and thank you so much. If you have any questions, feel free to contact us. We have an open door policy, an open book policy. So we would love to have you invest with us. So thank you so much, everybody, and look forward to having you on the team. Bye.